This analysis is for informational purposes only and does not constitute investment advice. If you evaluate Formula One as a sports entertainment or media company, you are making a severe analytical error. Formula One operates as a high-margin infrastructure toll road. It extracts value from a massive underlying ecosystem of manufacturers, broadcasters, and promoters without bearing the primary operating costs of the sport itself. The participating racing teams spend between $3 and $4 billion annually on research, engineering, and car development. Formula One management invests less than 2% of its top-line revenue into capital expenditures. They own the road and charge everyone else to drive on it. This chart shows the exact breakdown of Formula One's revenue streams. The toll road monetizes through 4 distinct pillars. At the base, media rights generate 31% of the total, operating as exclusive regional broadcast licenses. Right below it, race promotion makes up 27%. This functions as a fixed-fee infrastructure license, charging local governments and operators up to $60 million simply for the privilege of hosting a circuit. Moving up the stock, sponsorship accounts for 22%, functioning as the highest margin growth vector, with brands paying for exclusive category association. Finally, hospitality and other revenues make up the remaining 20%, driven largely by the ultra-premium, highly inelastic corporate Paddock Club. Because Formula One does not manufacture cars, build circuits, or pay drivers, it carries virtually none of the physical overhead that plagues traditional sports leagues. This structural separation isolates the company from manufacturing risk, securing its position as an elite, high-margin infrastructure asset. The legal foundation of this model rests on a single document. In 1995, the FIA granted Formula One management an exclusive commercial rights contract. This agreement persists until the year 2110 and is completely irrevocable. It legally prevents the emergence of any rival global single-seater championship, establishing an infinite barrier to entry that no other sports property possesses. On top of this monopoly, roughly 70% of Formula One's total revenue is locked into multi-year contracts. These agreements contain automatic annual price escalators of 3 to 5%, effectively shielding the baseline cash flow from macroeconomic downturns and global recessions. This chart illustrates the leverage mechanism that turns that protected revenue into expanding margins, the 2026 Concord Agreement. The agreement contractually dictates how revenue is shared with the racing teams. Notice the sharp downward trajectory of the orange line. This represents the percentage of commercial revenue paid out to the teams, which is programmed to compress by roughly 200 basis points every year through 2030. As top-line revenue scales upwards, the cost of team payouts scales at a structurally slower rate. The result is pure operating leverage. Every marginal dollar earned falls disproportionately straight to Formula One management's bottom line. A century-long legal monopoly, combined with contractually guaranteed margin expansion, creates a cash-generating engine that is structurally immune to normal competitive forces. Liberty Media recently signaled an evolution into a broader sports conglomerate by acquiring MotoGP for $4.2 billion. But this expansion occurs right as the core Formula One property faces severe operational friction. The immediate threat to the cash engine is a sharp deterioration in the quality of the on-track product, driven entirely by the newly implemented 2026 technical regulations. Drivers are openly criticizing the new 50-50 hybrid power unit formula, describing the vehicles as Formula E on steroids. The heavy reliance on battery deployment has created massive speed differentials between cars on straightaways, introducing severe safety risks that simply did not exist in prior seasons. The market reaction to this degraded racing product has been swift. Key European markets, including Germany and Spain, have already recorded viewership drops of 40 to 50% in the early races of the season. This dissatisfaction extends to the sport's most valuable asset. 4-time world champion Max Verstappen is in the final year of his contract and has publicly stated he is not enjoying Formula One as a whole, explicitly threatening early retirement. Compounding the regulatory crisis is a massive strategic gamble in the United States. Formula One has transitioned its broadcast rights to Apple TV, locking the sport behind a strict streaming paywall. Moving away from free-to-air linear networks like ESPN creates a casual viewership cliff. The company is deliberately trading massive general audience reach for a much higher revenue yield per subscriber. a move that directly complicates future growth. Locking the sport behind a streaming paywall at the exact moment the on-track racing product noticeably degrades is a massive strategic vulnerability. A structural monopoly guarantees revenue, but it does not guarantee shareholder returns. That outcome depends entirely on the executives managing capital allocation in the boardroom. At the operational level, CEO Stefano Domenicali possesses an exceptional track record. Under his leadership, Formula One management compounded its standalone revenue from $2.1 billion to nearly $3.9 billion in just 4 years. His success relies on decades of deep, specialized relationships with drivers, teams, and the FIA. Because there is no documented succession plan, Domenicali represents a severe single point of failure. If he departs, the operational vacuum would be immediate. The risk intensifies at the holding company level. There is a glaring structural misalignment between voting power and actual financial exposure. This table breaks down the ownership structure. Chairman John Malone controls 49% of the voting rights, but holds only a 2% economic interest in the company. That 24-to-1 gap ratio structurally divorces his incentives from those of the minority shareholders. Against the backdrop of this unaccountable government structure, insider activity presents a clear warning. Chase Carey, the former CEO and a founding architect of the modern business, recently liquidated approximately $26 million of his equity in a rapid 37-day window. When the architects of a business aggressively extract capital under a board structured to resist minority shareholder influence, long-term investors must evaluate the operation with intense skepticism. To determine if the structural moat outweighs the operational friction, we must look at the math. The entry point for this analysis is the current valuation, hovering at $83 per share. At that price, the stock trades at roughly 25 times forward free cash flow. For a standard media company, that multiple implies heavy growth expectations. For an asset holding a legally enforced 100-year global monopoly with highly predictable escalators, it is entirely justifiable. This chart projects out 5 years of cash flows, outlining a conservative path to a 13% internal rate of return for investors. Crucially, this return profile does not require the market to re-rate the stock. It assumes the 25 times multiple remains statically flat all the way through the exit year. The return is driven instead by the steady internal compounding of free cash flow per share. This is generated by the contractual revenue growth and the baked-in margin expansion of the Concord Agreement we examined earlier. The final piece of the engine is the capital return program. Assuming free cash flow is directed toward buybacks, the company is projected to retire roughly 44 million shares over the next 5 years, shrinking the float from 251 million to 207 million. The true strength of this investment thesis is that it actively ignores market sentiment. It relies entirely on the inevitable generation of cash and the aggressive reduction of the share count. The analytical tension lies in the timing. Formula One's financial metrics are lagging indicators, locked in by long-term contracts. They look pristine today, but viewer sentiment and product quality are leading indicators, and they are actively deteriorating. We will see these forces collide immediately in the upcoming May 2026 earnings disclosures, followed closely by critical data from the Miami Grand Prix. These events represent the ultimate test for the Apple TV streaming strategy. The numbers will definitively prove whether the paywall is suffocating domestic growth or if the premium audience successfully justifies the cost. Yet beneath that near-term turbulence, the core identity of Formula One remains intact. It is a global toll road, continuously extracting value from an exclusive network, regardless of cyclical economic conditions. The product may falter and the audience may complain, but the underlying contracts ensure the cash continues to flow. Evaluating this business requires a delicate balancing act. You have to weigh the immediate, chaotic noise of operational friction against the unyielding, mathematical permanence of a century-long structural moat.